Welcome to Celebrity Investing, your go-to source for insights, tips and updates on navigating the exciting landscape of personal and global finance. Please like, share and subscribe for more exclusive content. This is part 2 of navigating the opportunities and risks of emerging market bonds in 2024. Direct investment versus funds. When it comes to investing in emerging market bonds, you have two primary approaches: direct investment in the bonds themselves, or investing through mutual funds or ETFs. Each has its perks and pitfalls. Direct investment. Control. Buying bonds directly gives you complete control over your investment decisions. You choose the specific bonds, allowing you to tailor your portfolio to meet specific risk and return preferences. Transparency. You have a clear picture of where your money is going. There's no intermediary fee or manager deciding on your behalf. Liquidity risks. Emerging market bonds can be less liquid, making them harder to sell quickly in a pinch. They often require larger minimum investments, which can be a barrier for smaller investors. Funds. Mutual funds or ETFs. Diversification. Funds automatically give you a diversified portfolio, spreading risk across multiple bonds from various issuers and countries. Professional management. With funds, you benefit from professional expertise. Fund managers have the experience and resources to make informed decisions, though this often comes with management fees. Liquidity and access. Funds, especially ETFs, offer greater liquidity. They're easily traded on exchanges like stocks, so you can buy or sell quickly. Choosing between direct investment and funds boils down to your investment goals, risk tolerance, and the level of control you desire. Active versus passive management. Another consideration is whether to go with actively managed funds or lean towards passive index funds. Each approach comes with its own set of advantages and drawbacks. Active management. Potential for higher returns. Active managers aim to outperform the market by picking bonds they believe will score higher returns. They leverage their market insights and tactical adjustments. Higher fees. With the added expertise comes a higher price tag. Management fees can eat into your returns, so you need to weigh the potential gains against these costs. Flexibility. Active managers can pivot strategies quickly in response to market changes, potentially safeguarding your investments from volatility. Passive management. Lower costs. Passive funds typically have lower fees since they track an index rather than trying to beat it. This can make a big difference in your net returns over time. Consistency. These funds provide broad market exposure and are designed to match market performance. This approach may not yield explosive gains, but it offers steady growth potential. Limited adaptability. Unlike active funds, passive funds can't adjust holdings based on market whims. They are bound to the index, which may leave investors exposed to specific market risks. The choice between active and passive management should reflect your personal investment strategy. Are you willing to pay more for the chance of higher returns, or do you prefer a cost-effective, hands-off approach? Understanding these dynamics will guide your decision-making process and help you harness the power of emerging market bonds effectively. Challenges in investing in emerging market bonds. Investing in emerging market bonds can seem like a thrilling ride on a roller coaster. There are highs with attractive yields and lows with inherent risks. Before jumping in, it's essential to understand the typical challenges you might face. Let's break down a couple of key obstacles that could affect your investment journey. Market volatility. Emerging markets are known for their volatility. Like the weather, they can shift dramatically, creating rough seas for investors. Why all the ups and downs? Several factors contribute to this instability. Economic instability. Many of these markets have economies that are still growing and developing. Suppose there's a sharp change in economic conditions, such as inflation spikes or recession. It can significantly impact bond prices. Political risks. Governments in these regions may experience frequent changes in policy or leadership, which can lead to uncertainty. Political instability can scare investors, causing bond prices to plummet. External shocks. Global events like interest rate changes in developed markets or geopolitical tensions can send ripple effects through emerging markets, affecting their bond markets. For bond investors, these factors can mean that prices swing more dramatically than in more mature markets. It's like riding a financial wave, thrilling yet potentially risky. Regulatory environment. The rules of the game in emerging markets can shift unexpectedly, like the changing seasons. This poses a significant challenge for investors in bonds. Changing regulations. Regulations can change quickly and unexpectedly. Governments may suddenly impose new taxes, adjust interest rates, or alter financial regulations, making it harder for investors to plan. Transparency issues. In some cases, regulatory environments might lack transparency. This makes it difficult for investors to get a clear picture of what's happening, creating uncertainty. Barriers to entry. Some markets have strict foreign investment rules, limiting access to foreign investors. Overcoming these hurdles can be like trying to solve a complicated puzzle. These regulatory challenges demand vigilance from investors. Staying informed and adaptable is key. Like a chess player, you need to anticipate moves and react quickly to regulatory changes to safeguard your investments. Investing in emerging market bonds isn't for the faint of heart. But for those who can navigate these challenges, the potential rewards are significant. Keep your eyes open and your strategy flexible to make the most of these opportunities. Future trends in emerging market bonds. As we look to the future, emerging market bonds are set to become a focal point for investors worldwide. The landscape is shifting, with trends that promise to reshape how these bonds are issued, traded, and perceived in financial markets. Here are some key trends that could redefine the contours of emerging market bonds in the years ahead. Impact of globalization. Globalization plays a pivotal role in dictating the flow and intensity of capital into emerging markets. It acts like a double-edged sword, bringing both challenges and opportunities to the table. Increased capital flows. As global trade and investment barriers continue to diminish, emerging markets might attract more international capital. This influx can lead to increased demand and issuance of emerging market bonds. Investors are no longer tied to their home countries. They're branching out, seeking higher yields and diversification. Risk dispersion. With globalization, risk is spread across borders more seamlessly. This can stabilize bond markets as investors hold diversified portfolios that help buffer against localized shocks. Isn't it fascinating how capital can zip around the globe, balancing risks like a tightrope walker swaying in the breeze? Economic interdependencies. On the flip side, globalization leads to interconnected economies. A hiccup in one corner of the globe can ripple through these markets, impacting bond values and investor sentiment. Those investing in emerging markets need to pay close attention to international economic trends. Technological advancements. Technology is breaking down barriers like never before, transforming how bonds are traded and managed. For emerging market bonds, these advancements are a game changer. Digital platforms for trading. The rise of online trading platforms and digital exchanges allows investors to access emerging market bonds with unprecedented ease. Imagine having the power of a trading floor at your fingertips, opening doors to countries you might never visit physically. Blockchain and smart contracts. These technologies promise to enhance transparency and reduce fraud in bond markets. Smart contracts can automate processes and enforce terms without the need for intermediaries. How's that for cutting out the middleman? It'll streamline transactions and potentially lower costs for investors. Data analytics and AI. Advanced data analytics and artificial intelligence tools provide investors with deeper insights. They can analyze economic indicators, track market sentiment, and predict trends more accurately. Harnessing these tools can give investors an edge in identifying lucrative opportunities in emerging market bonds. These trends suggest a future where emerging market bonds could become more accessible and attractive to a broader range of investors. The fusion of globalization and technology is set to redefine the parameters of risk and return, promising a dynamic and evolving investment landscape. As these trends unfold, keeping an eye on the horizon can offer valuable insights for astute investors. Conclusion. Emerging market bonds offer a unique blend of potential and risk. They're not just another investment option. They hold the promise of high returns and diversification. But they demand careful consideration. As you've learned, these bonds come with credit risks, currency volatility, and market swings that aren't for the faint-hearted. Investors should weigh these factors against their financial goals. If you're open to the risks for potentially rewarding yields, emerging market bonds could add vibrancy to your portfolio. Keep an eye on global trends, technology's impact, and economic shifts to stay ahead. Ready to dive in or still on the fence? Share your thoughts and investment strategies below. Let's keep this conversation alive and thriving in 2024 and beyond. Happy investing! Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.